And it's our top option story, HP. But in the long term, the stock is down big today after the company said that falsified accounting documents tied to its purchase of a UK software maker, Autonomy, led it to write down $8.8 billion in asset values. This blow comes after HP has already been suffering from leadership changes. But long term, is there hope for the company? Let's see what the options market says. Joining us now, Tim Travis, president of T&T Capital. So, Tim, this story for HP, it's been a down one for about 3 years now, and this just seems to be another ding in the whole story. So what exactly are traders saying about the prospects for HP, given what's happening with that $8.8 billion write-down today?
Well, Dominic, I think that write-down was built in the cards the day the acquisition was announced. I think we knew that they overpaid. Previous management obviously should take most of the blame for that. But if you look at the actual fundamentals of the business, they are generating a lot of cash. They generated about $8 billion in non-GAAP earnings. Their financial situation, they have a net debt of $5.8 billion if you back out the financial services division. So I think that they're going to pay off most of that this coming year. And then at that point in time, they should be able to buy back stock, and I think you'll see some of those businesses rebound with a better economy. So that's why we're a little more bullish than most folks.
So you're talking right now about this idea that with HP, we might be seeing a bottom in sight here, only because the valuations have become so compelling, given the fact that they still have businesses that do generate cash and do generate at least some kind of positive profit or cash flow ability here, right?
That's exactly right, Dominic. Yep.
Now, if you look at why you're doing it now at these levels here, the stock has obviously been taking a beating today. Sure. What exactly is the play from an options perspective if you want to be more of a longer-term bull, say, on those HP shares?
Sure. Well, just this morning, we sold the $10 puts for January 2014, so going about a year out. We collected about $140 per contract. So basically, two things can happen. Assuming that HPQ trades above 10 at expiration, you're going to make $140 per contract. That's about 16% on the maximum risk. Worst case, you're going to end up owning the stock at $8.60 a share. And we feel that the stock has potential to double over 3 to 5 years. It's a long-term process. We were early. I'll be the first to tell you. It hasn't been a successful investment for us over the last year. But we dollar cost average, and this is the type of distressed investment that we like.
So, Tim, in essence, by selling the January 2014 $10 puts, you're going to own the stock at $10 per share, but you've already collected $140, making your adjusted cost basis that $860, right?
Exactly right. Yep.
Gotcha. Perfect. Tim, thank you so much for giving us that look here on HP options here. Viewers, bottom line on this option, Tim Travis, he's over at T&T Capital. He says that despite all the large issues facing HP, now really what he thinks is that he should, at least for HP, recommend selling the January 2014 $10 puts. He says that the worst that could happen is you end up owning the stock at an adjusted cost basis for HP at $8.60 per share. So that does it here for the option side of the menu.